ECN listeners, this is your FX Weekly Update brought to you by Rare ECN. This weekly update commentary will focus on the Euro-dollar market. Without a doubt, last week's Euro-dollar price action is a clear indication that the bear continued to hold a strong upper hand over the bull, as technical indicators all point to sell recommendation at the beginning of this week's trading session. This week's risk opportunity is packed for a market-inducing volatility risk events, catering well for traders who are trading on volatility swing in the Euro-dollar market. The volatility comes in the form of Eurozone and German PMI number to ECB minutes, as well as Friday US non-farm payroll print. So this commentary will be broken down into two components. The first component that we will explore is the technical aspect of the Euro-dollar market. Last week's trading session represented continued weakness in the Euro-dollar pair, as the bear continued to hold and have a strong grip over the bull. The current price action on the Euro-dollar pair indicates that the pair is trading between the 76.4% expansion marked by the 1.31507, which formed the resistance, and the 100% expansion, which formed the support at the 1.30640. Analysis of a collection of technical indicators on the hourly time interval on the Euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend long position on the greenback. The Euro-dollar cross opened today's Sydney trading session 1 pip below the Fibonacci support at 1.3132, while the Fibonacci resistance is set at 1.3144. Since last week's Euro-dollar correction to the downside and broke below the 200-day simple moving average, it hasn't managed to break above it yet. This is very indicative of a long-term bearish outlook on the cross moving forward. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30-day simple moving average, which is indicative of a sell recommendation on the moving average front. Moving along to the fundamental analysis of the Euro-dollar market, the month of August will surely be defined as the great month for the greenback, especially against a single currency. One of the underlying reasons to the most recent strength in the greenback is the divergence in the ECB monetary policy from that of the Fed. US leading economic indicators do support an improving economy. For instance, last week US GDP quarter-on-quarter print accelerated at its fastest pace yet at 4.2%, when consensus only forecast a 3.9% expansion. On top of that, the US GDP price index quarter-on-quarter also grew by 2.2%, beating expectation of a 2% reading. US home sale month-on-month price also expanded by 3.3%, beating economists' forecast of a sluggish 0.5% expansion. However, one hiccup of Tier 2 US leading economic indicators comes in the form of personal spending month-on-month, which contracted by 0.1% when forecasts expect a 0.2% reading. Nevertheless, the greenback managed to trade higher against the euro on the back of an accelerating Mexican consumer sentiment ticking at 82.5 above the 80.1 forecast. Last week, Yellen's Jackson Hole conference provided the market with very little direction or a time frame on its interest rate hike forecast. Nevertheless, there are numerous number of leading economic indicators out from the US this week that will certainly trigger volatility in the Euro-dollar market. So starting this week trading session in the US is the ISM manufacturing PMI expected to expand at 56.9, while the manufacturing employment component is forecast to come in at 58.4. On Wednesday, the market can expect the release of the US factory order month-on-month print, forecast to expand by 11%. Heading into Thursday trading session, the release of the US ADP non-farm employment change is forecast to come in at 220K. This private sector employment print is often used as a gauge in predicting the US non-farm payroll number. In addition to that, the US non-farm productivity quarter-on-quarter is forecast to expand by 2.5%, and its ISM non-manufacturing PMI is expected to read at 57.6. Wrapping up this week's trading session is Friday US non-farm payroll print, forecast to come in at 220K. While its unemployment rate is expected to tick lower at 6.1%. So over in the Eurozone, this week's major risk event will largely be dominated by the ECB meeting and the release of its minutes, and its momentum to induce volatility in the price action of the Euro-dollar market cannot be understated. Last week, disappointing Eurozone leading economic indicators strongly support a call for further stimulus as growth is beginning to show signs of stagnating in Germany. For instance, last week German unemployment claims report grew by 2,000 claims when the market only expected 5,000 contraction. In addition to that, the German CPI month-on-month prints failed to grow, while its retail sale number contracted by 1.4%, surprising a 0.1% expectation. Eurozone core CPI year-on-year, on the other hand, did manage to beat expectation by ticking in at 0.9% above expectation of a 0.8% reading. This uptick in CPI number has had the potential to hold further dovish bias by Draghi during this ECB meeting. The bank LTRO program will be implemented in September, and most likely will the bank wait to monitor the progression of the stimulus and liquidity injection into the economy before implementing further additional stimulus program. Since the market is very forward-thinking, investors are beginning to price in the time frame of the next stimulus package. Most likely, the ECB will lower its GDP and CPI forecast for the Eurozone, and this action in itself will work to reinforce the build-up in the bearish bias on the single currency. Volatility will come in many forms for the single currency during this week trading session. For example, on Monday, the German will release its GDP year-on-year print, expected to come in at 0.8%, while its GDP quarter-on-quarter forecast will contract by 0.2%. In addition to that, the German manufacturing PMI print is expected to remain in growth territory at 52, while the Eurozone manufacturing PMI is forecast to come in at 80.8. On Wednesday, the German will also release a service PMI print, which is expected to read at 51.1, while the Eurozone service PMI number is forecast to come in at 53.5. In addition to the Eurozone retail sale number is expected to contract by 0.4%, while on Thursday, the German factory order month-on-month print is forecast to sluggishly grow by 1.5%. Also on Thursday is the highly anticipated ECB press conference, and wrapping up this week trading session is Friday Eurozone GDP year-on-year print forecast to expand by 0.7%. Thank you everybody for listening, and have a successful trading session.